Welcome back to the Investor Professor Podcast. This is Dr. Ryan Peckham, and this is episode 51. Well, if you're looking to get confused this week, this is the episode for you because we're going to go over SPACs, special purpose acquisition companies. Might be more like a little vignette episode, but I wanted to cover this topic because there's a lot of companies that have done this over the past couple of years. How to protect yourself from them, just know what they are, just a general education episode on what a SPAC is. So without further ado, let's get to work.
You drop this.
All right, well, thanks for joining me again. This is going to be a fun and hopefully not confusing episode, but I've been wanting to cover this for a while and don't know if I can do it justice, but I'm going to give it my best shot. I'm going to give it the old college try, as people like to say. So this episode is going to be over SPACs, which is a special purpose acquisition company. And it's a different way to bring a company public, bring a company to market, if you will. So when we say bring a company public, that means that other, retail investors can invest in this. So you have to know how normally this is done. So normally you have an IPO, which stands for initial public offering, which is, how it's consider that the traditional way that a private company decides to enter the public market, right? And so this is kind of something that confuses a lot of people, but the primary market for investing would be you invest in a private company, but you wouldn't have a way to get your money out, right? So the public market, and what we think of as the stock market, is really the secondary market, which is where like I can sell shares and you can buy them, and we can buy and sell shares all day long in public companies. So this is really where if you have a private company that's grown substantially and they want to be able to liquidate or get some of their money out of that company, taking it public is the way to do it. So an initial public offering is the way that it's normally done. This is where investment bankers help. This would be, think of Goldman Sachs, Morgan Stanley, your traditional investment bankers that are looking for trying to figure out if there's interest in these companies. So they go around, they do what's called a roadshow. There's regulatory hurdles. They're looking at the financials of a company. They're really trying to protect themselves and protect investors from knowing what companies are real or not real. So these investment bankers make a heavy sum from doing this, which is, part of the reason the SPAC has become popular, is trying to prevent that fee from taking place. But there's also a lot of risk when it comes to an IPO because the investment bankers purchase shares from those private companies and then they sell those to the public market. So if they don't price it right, there can be risk for the companies if they sell their shares too low to the investment bankers. But there can also be risk of if the investment bankers price it too high and then they take a loss on those shares. So there's always a risk here, and they're trying to find the delicate balance. But when you do an IPO, there are financial regulatory hurdles. It's costly, but there is a lot more due diligence than when you have the SPACs. So when you look at SPACs, these special purpose acquisition companies, they've been around for a while. But recently, in the past 2 years, really, did they really start to get, very, very popular. Some will say that they're trying to get to the public market quickly so that they could take advantage of kind of the euphoria that the market was having. But here's just some numbers for you. So in 2019, there were 59 companies that went public via SPAC for $13.6 billion. And then in 2020, there were 248 companies that went public via SPAC for $83 billion. And then last year, there were 630 companies that went public via SPAC for a total of $160 billion. And then of April of this year, that had dropped to 58. So definitely the wind has come out of the sails for this. But just looking at what happens with that, so a SPAC is basically a shell company. There's no assets. There's really nothing going on in the company. They're trying to raise money, so they raise it via a sponsor. And so the sponsor can be another company. It can be like a hedge fund manager. Bill Ackman would be one that you might know that has done this. And they're basically going around and they're saying, okay, we have this company, and you'll hear the term blank check companies, where they're basically going around trying to raise money for this company. And then within 2 years, they have to acquire another company, a private company. Then they basically merge them together inside of this to have a true public company, if you will. So it's basically like, we're going to take advantage of the markets here. We're going to try to raise a bunch of money real fast, combine with somebody else, and then we'll have like a real company. So this is where you can kind of see where there's not a lot of regulation. You know, investors can get burned. Probably, maybe one of the most famous ones is that WeWork tried to do a traditional IPO a couple years ago, and it fell apart because regulators and financial analysts said, "Man, this doesn't look as good as we thought it did. There's kind of some fishy stuff going on, you know." And the IPO actually fell through, and now they've gone public via a SPAC under the symbol WE. And so, you know, as an investor, you really have to protect yourself between knowing what's a real company, what's a shell company in the form of a SPAC. But the hard part is it's really, unless you're doing your homework, there's no way for you to really know, because when you go and you type these symbols in, and when I give you some of the names of these, you're going to know who they are, but you're not going to know that this is how they became public. And so, you know, most retail investors are not going to do enough homework to know that this is how these companies became public. And so, unfortunately, they can set themselves up for maybe disaster, because it's, you know, they're going to get hurt and not know that they were basically set up to get hurt. So looking a little bit deeper into these, the sponsors that do these deals normally get around 20% of the overall deal, right? So obviously there's an incentive there for them to make these work, to find enough investors to make it work. It becomes profitable. That becomes profitable for them. That becomes a problem later on when they're trying to find somebody to acquire, because they have a 2-year window to do so. And so at the end, if they start looking towards the end and they haven't found somebody yet, you know, there's an incentive there for them to find anybody to be able to make this happen. So, you know, normally these SPACs are priced around $10 a piece. And then early investors, they get warrants, which is a type of security that gives them the right to buy additional shares at a predetermined price. So if the share prices go up, they're able to buy at a lower price, which could dilute the shareholders. So if they find a merger partner, it can be financially rewarding for them. And they have that, again, I've said it, they have 2 years to find an operating business to buy. Otherwise, the money has to be returned to investors. So that, again, later on, if they haven't found somebody, they're going to try to make it work with somebody. And so it could, you know, they could be worth a lot less than the cash that they've raised. And so over the past year, with everybody just buying into everything, you know, some of these have worked out well until the previous year. So one of the ones that you might know of is Virgin Galactic, might be one that you've heard of. That was a SPAC. DraftKings has also been a very, very popular one. WeWork, which I mentioned, and that one raised $1.3 billion in capital that it really needed. And so, you know, do these work? You know, most investors, they redeem these shares, but a lot of times if they're not working out well, obviously they're going to want to get out of them. But if they're underwater, they're going to be basically putting pressure on the sponsor to find somebody to merge with. And so that can become, it can become bad for the investors that invested in this, because 2 years later, they're looking for somebody for them to partner with. And so they're going to just have to pick somebody to get on the dance floor with. And so now, because some of these have started to turn out poorly, obviously there's people in the government, regulatory agencies trying to put some pressure on there. But of the 600 SPACs that went public in 2020, 2021, 207 are still looking for somebody to buy or looking for a partner. And so that could be, not a good sign when it comes to them actually being redeemed. So you look at some of the ones that are kind of the most popular ones. You have Virgin Galactic, you have DraftKings, you have Nikola. Those are all SPACs that have gone. There's actually an ETF you can buy called SPAC, SPAK, that is basically an ETF that has all of the SPAC companies in one ETF. And okay, so how is that done? Well, this has only been around since 2020, and since inception, they're down 40%. So they did okay for a while, but actually they really didn't. So 1 year they're down 38.75%. Year to date, they're down 29%. And since inception, let's call it, they're down 40%. And so, and they hold all the ones that I just talked about. They also hold SoFi Technologies, which SoFi is one of the buy now, pay later companies that we discussed a couple weeks back. They own DraftKings, just all these that I've discussed already. And so my point on this isn't for you to really understand the nuances of what a SPAC is, but it's more of you need to protect yourself when you're buying into companies that are relatively new, IPOs or SPACs. Another big one is the Digital World Acquisition Corporation. DWAC, DWAC is its symbol. So this is the Donald Trump new social media platform. That's his SPAC company that went public last year. So there's a lot of investors that are doing this, but you have to realize that the retail investors that are buying into them are normally at a worse spot to be able to profit from these. These are not companies that are going to pay dividends or do buybacks. You might get some growth down the road on some of these, but it's definitely an area that you need to do your own homework and you very, very much need to protect yourself with. And like I said at the beginning, the hard part is that when you're looking up these symbols, there's nothing that tells you that, that this is a SPAC and they need to find a partner within the next 2 years in order to make this happen. So if you look at one like DraftKings, let me pull up their symbol here. DraftKings is now trading for $12.65. And in March of last year, it was $61. And so it came public at $9.85. Again, it's that $10. Most of these you're going to find that they came out around $10. And it did do well for a while, but now it's come all the way back down. They have negative earnings per share. So when you look back at kind of the things that we talk about, making sure a company has earnings per share, looking at their PE ratio. Of course, PE ratio is price over earnings. So if the company doesn't have any earnings, it's not going to have a PE ratio. So DraftKings doesn't have a PE ratio. It's not profitable. So this is an area of the market that you really have to protect yourself with. So again, not that you have to know all the ins and outs of what a SPAC is, but it is an area that you should protect yourself with. IPOs as well. Normally after an IPO, initial public offering, stocks trade kind of sporadically. This can be for a couple of reasons. It could be that the people that are within the company, maybe the employees, maybe it's the early investors are trying to liquidate, have a liquidation event where they're trying to sell out. Normally in an IPO, there's a 6-month waiting period before insiders can sell. So normally at that 6-month period of time, you'll see the stock drop because they're trying to get out of some of their shares. And so there's always just a little bit of a kind of a wonky period when companies go public. So it doesn't mean you can't invest in them. It just means that you need to know what's going on and protect yourself and maybe start a little position and tell yourself you're going to add to it later on. I mean, rarely do you have a company IPO and it goes straight up afterwards. I mean, even Facebook dropped after its initial public offering. One of the only ones I know of that went basically straight up was Google. And so there's normally just kind of an adjustment period. So, just be aware of that and protect yourself when companies go public, because the investment banks and that are taking them public, they're trying to drum up a lot of attention and a lot of buzz around that stock, and they're trying to get people into it. They want to have a successful IPO. But the problem is once they have a successful IPO, I mean, their job is to go find another one. So then they take that marketing team and that buzz machine and everything else, and they go apply it to the next one. So, don't feel like you're going to miss it if you don't get in right on the first day. You can wait a while. I mean, even if you look at some of the ones that were some of the most anticipated IPOs over the last 5 years were Uber and Lyft. And you go look at their chart and you'll notice that, you can still get in those at a pretty good price compared to where they IPO'd. So don't let the buzz and the attention in the beginning make you feel that you're going to miss out. But that's what they want, right? FOMO, fear of missing out. So just be careful and do your research and be methodical about it to prevent yourself from getting into something that you weren't aware of what it really was. So I hope you find that helpful. If you have questions, send them our way. We'll try to answer them as best as possible. As always, I appreciate you. Have a good week. Don't mistake activity for achievement. I'll see you next time.